Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Fil Zucchi, Marko, and Tracy Shuchart. We're going to be talking about what are corporate bonds and CDS telling us about equities. Phil is an expert in corporate bonds and corporate debt, and I really can't wait to figure out what he has to tell us. We're also talking about U.S. politics. I've titled this Super Boring Tuesday. Super Tuesday was kind of a yawner. It was kind of what we expected, but I think there's a lot more to it than that, of course, and Albert's going to fill us in on that. And then we had some news over the past week about dumping of the U.S. gasoline reserve, and Tracy has some thoughts on that, of course, and I can't wait to hear about that. Hi, everyone. We've introduced new subscription tiers for CI Markets. More data, more insights, and more options. CI Markets uses the power of AI to help you make better trading and investment decisions. It's a perfect addition to your analysis toolbox. CI Markets Free is our first tier. It's absolutely free, no strings attached, and it does not require any credit card information. Next, we have offerings at $7.95, $14.95, and $24.95 per month. Each of these offerings includes different forecast assets for stocks, ETFs, commodities, and currencies. Go to completeintel.com to find out more and subscribe. Hope you'll join us soon. So let's start with you, Phil. Phil, welcome, and thanks for coming on the show. I really appreciate it. I know you're a busy guy. Everyone's busy, and I'm just grateful when people can join us. So you were telling me before the show about kind of that you ran a hedge fund for a period of time, a small one, you said, and that you got to learn about corporate bonds and derivatives, which is great. We haven't covered that on the show before, so I know our viewers will learn a lot today. So you gave me some notes that really cover the dynamics of the corporate bond market, credit derivatives, CDS, and equity markets over the past, few decades, I think. And obviously that's super interesting. So would you mind, can you give us a general overview of kind of how did you get to know corporate bonds and the derivatives around it, and kind of long-term causal links? Because I think that's the language you use around causal links between those things. So it's not just some coincidental activity, but the causal links with things like bond issuance and share buybacks.
Sure. Well, first of all, thanks for having me. It's good to see everybody. Yeah, so when I started my small fund, I was prime brokering with a broker-dealer whose chief financial or chief market strategist was Brian Reynolds. And Brian is the one who came up with the thesis that since basically the inception of the high yield market back in 93, 94, Michael Milken and that crew, the broader market has been moved by the flow of money into corporate credit, which in turn has been used to a large degree to fund buybacks and M&A. It took me a long time to believe that was the case. I fought it because I always came to equity markets from the standpoint of the basic fundamentals and technicals and macro and this, that, and the other. And the fact was that using those tools, again, vis-a-vis the market as a whole, it really wasn't working. Things weren't behaving the way that I thought they should behave given those other signals. And so finally I started to dig in, and sure enough, I found what I think is causality between the rise and the big secular rise and falls of equities, and the ability of companies to access the credit markets to fund buybacks and M&A. And then on a more granular level, because obviously these are very, very long cycles, for, let's say, shorter term timeframes, I started drilling into credit default swaps because as the CDX, the indices of CDSs became more and more popular as trading vehicles, it became apparent that credit bears would begin whenever they wanted to stir up trouble, they would start in the credit default swaps indices, and they would start pushing that. And then ultimately, if they managed to shake up the sentiment and the appetite for the cash bonds, then buyers would pull in their horns, and you would have periods of where markets and spreads, markets would dry up a little bit, and then spreads would widen, and the bears would press it more and more and more, and those would be, let's call it, cyclical to tradable bear rates. But ultimately, once things stall in the CDX market, and the bears have to cover pretty quickly because it's not obviously nearly as liquid as the equity markets. And the place they go first is the index futures. So if they feel they've had enough or that things are turning against them, since it would take them a little bit of time to unwind the CDX positions, they would tend to get into the S&P's futures and basically hedge out their risk that way. And that's sort of the dynamic on a shorter term frame.
So in general, what's the time frame you're looking at for your investment horizon? Because we talked to a lot of people here who are looking at, say, 1 to 2 months, and obviously some longer term. But what are you looking at?
Yeah, I usually take positions for 3 to 9 months. I've owned some stocks where I trade options around them for a lot longer than that. But that's roughly the time frame that sort of is instructed by the corporate bond market, because there are 2 critical periods for corporate bonds every year: the January issuance period, and then the September issuance period. If you see issuance not going well relative to the past, if you see cash spreads widening during those 2 months, you can pretty much, not pretty much, but the probabilities become slanted pretty hard that there is going to be weakness, and for a number of months. And then during other times of the year, yes, you want to watch, make sure that issuance remains in line year over year, but it is a little less telling than in January and September.
Okay, so I just want to make sure I understand this and break it down into simple terms. So what you're saying is companies issue debt, and they use that debt to, 1, buy back shares, or 2, spend it on M&A. Those are the primary uses of that debt that's issued. Is that fair?
Yeah, I think it's probably, I get researched the monthly chart books from Morgan Stanley, and they break out, it's a very useful tool. They break out how corporate debt is allocated by companies. And if I recall the last time I looked at it, you have roughly 20 to 30% of corporate debt that goes to buybacks on a regular basis. And of course, then companies can also use their cash flow, because some companies that have huge buybacks have enormous free cash flow every year. So, but Apple is a classic example. They usually announce their buybacks plans in April, and they will come to market in May or June with large issues, and that's basically what they use for their buybacks. Now, that arbitrage using cash flow versus debt, now it's going to change a little bit because obviously, the cost of capital, the cost of debt right now is higher than it used to be. But before, it was a no-brainer. I mean, you borrow it at 25 beeps above treasuries. Why not? I mean,
Right.
That's
okay. So I want to, you send me some data, and I'm sorry for people looking at this on the screen. But you sent me some data around credit issuance. And it shows me that in 2024 so far, Jan is the largest that, since in the last decade. It's the largest, at least in the last decade. And February is the largest in the last decade. So that tells me that in terms of credit issuance, if I take your kind of causal assumptions, that say, so that's 237 billion and 237 and 247 billion. Is that right?
yeah, it was almost $500 billion in 2 months.
Right.
So,
and if we look back to, so if we looked at 2023, that would have been a third of all of the credit issued in 2023 done in 2 months, right?
correct. It has been extraordinary.
Right. So what does that tell us? Does that tell us, okay, companies are taking out more debt, although it's at a higher interest rate, they're taking out more debt. Does that mean more share buybacks?
Yes. I mean, it doesn't translate to more share buybacks immediately. Usually there is a lag of, call it 3 to 6 months.
Okay.
But I think it does suggest the fact that companies are loading up their coffers, and they will probably put a fair chunk of that money to work by buying back their own stock. And what's also, I just want to point out one thing. If you look at that data, their 3 highest months of issuance were March, April, and May of 2020, which is counterintuitive because we were
Kind
in
of weird.
the throngs of COVID. But as we all know, the Federal Reserve jumped in, brought rates basically to zero. Now, interestingly enough, sort of the narrative and the conspiracy theories in the market was that the Fed was buying corporate debt. That's not true. I mean, that was just not the case. There are enormous players out there, insurance companies, pension plans, endowments, foundations, et cetera, who really do not care so much about what they have to, what they're staring at. They just need to match their assets and their liabilities. If they got a pension plan that needs to be funded at 7%, whatever it is, and the risk spreads remain muted, the buyers will be there. And so unlike every other time in the last 25 years, that massive issuance in 2020 was not earmarked for buybacks. It was earmarked for survival.
Okay.
And, companies saw the window open to load up on cash because that, like everybody else, no one had any idea how this thing, that COVID would work out. And so that's why they rushed to market. And oddly enough, I was not on the camp. They found buyers left, right, and center. And then, as we know, things pretty much normalized relatively quickly within a couple of years. And a lot of companies bought back their debt and a lot of them instead just bought back, used the money to buy back stock. So that was probably the only time period where large corporate issuance did not ultimately translate directly to buybacks.
Okay. So if we look at another table that you gave us, you look at announced buybacks, and this really shows very clearly that April, May in general are the largest months for announced buybacks. I mean, it looks like there are some blips in, say, October. We see that in 2021. But what you talked about Apple was really interesting. So tells me they're raising debt in markets in Jan, Feb. They're announcing buybacks in April, May, and then they're buying through the rest of the year. Is that your time frame?
Yeah, I mean,
how you do it?
that is the January, September periods aren't really driven by the desire for buybacks. There are cycles to corporate credit during which the market is more active because the buyers know that supply is coming, and sellers know that the buyers are lining up to buy. So those are January, September are kind of arbitrary months. It's just the way the corporate market works. But in the case of April being one consistently showing a lot of new buyback announcements, the bulk of it is Apple. Apple does it every April.
And Apple. Okay.
Apple may come to market, in May, June, whatever. It doesn't matter. That's more of a company specific thing. So you can see 160 billion in February. Well, the bulk of it was Chevron came to market with 55 billion. Okay. So you have these, sort of weird one-off by large companies. So I don't think that there is as much seasonality or consistency to the announcement of buybacks.
Okay.
It's just a question of seeing that the amount of buybacks announced over several months on average continue to be healthy. Okay,
great. Hey, I'd like to make sure you know that you can access our AI-driven market forecasting tool called CI Markets for free. No strings attached, and it does not require any credit card information. Go to completeintel.com/markets to subscribe. CI Markets is the perfect addition to your analysis toolbox. This free account includes Nikkei stocks, major currency pairs, and global economics. Of course, we offer much more in our paid account, but this lets you experience CI Markets before making a financial commitment. CI Markets uses the power of AI to help you make better trading and investment decisions. It's absolutely free. Again, go to completeintel.com/markets to subscribe to CI Markets free. Albert, Tracy, what are your guys' observations, questions about this stuff? Are you tracking with this? Does this make sense to you?
I mean, makes sense to me. I don't really track it as much as everybody else, but my only concern is corporate debt with interest rates, and that's the only thing I really paying attention of. It's other than that, it's above my pay grade, to be honest with you.
Okay, Tracy, are you seeing that? Like when you saw the Chevron share buybacks, how much of an impact did that have on you for oil and gas markets?
Not much, to be honest with
you.
Again, this is, corporate debt is not my forte, but obviously it involves many of the energy companies, but I think that doesn't really affect even the majors as much as perhaps some other companies.
Okay, interesting. So Phil, I want to go back to this other chart that you talk about in terms of, you gave me this bar chart looking at the impact of buybacks. So this is looking at cumulative purchases of stock. And that big bar chart that you see on the right is corporate buybacks. So it's much less than household, it's much less than pension funds, it's much less than governments, broker dealers, and so on and so forth. So corporate buybacks of shares is by far the largest cumulative purchases, and this is between 2007 and 2023. So, that causal relationship that you bring up, I mean, that chart is really, really compelling for me. Is there anything else to talk through on that?
No, I think that what it shows is that the various market participants basically swap shares between themselves back and forth, but there is no net buying by all these other market participants. Again, one of the oddities of the 2020 and 2021 was that foreign buyers stepped in, and the bulk of foreign buying, net foreign buying, basically makes up that second to last bar, which is the net buying by all participants, excluding buybacks. So the net buying there has been a little bit of net buying, but the bulk of it came during 2020, 2021 from foreign participants. Otherwise, people just swap shares among themselves. And it is when these buybacks come in that there is truly more demand than supply. And the interesting part is that the buybacks really don't tend to affect the prices of the companies themselves. I have never really looked at it very closely, but there is one ETF that invests in companies that have large buybacks and really hasn't done anything, different than the market as a whole, pretty much. But what happens is that the shares that are obtained for the buybacks tend to come from, the BlackRocks and the Vanguards and, their various funds. And once these shares are retired and these funds get their money, they don't stock pick for the most part. They just roll it out into their funds across the board, many being passive index funds. And that tends to levitate the whole market as a whole. So you don't see it at the company specific level, but that's kind of the fuel that lifts the indices over.
There's a smaller supply across the equity markets, right?
I'm sorry.
Okay, and it's interesting that you mentioned passive. We've had Mike Green on several times talking about passive, that's just a fascinating phenomenon on its own. So can we take a shorter term view? You talked about CDS spreads as kind of a shorter term indicator. Can you talk us through a little bit of that process and what you're looking for on CDS spreads and really what that means as a short term indicator?
Yeah, so there are three things I look at for short term, and by short term, again, I'm not a day trader, so that's not my bailiwick. But if I wanted to truly speculate over a 1 week, 2 weeks, 3 weeks period, I watch the cash spreads on high yield and investment grade, and I watch the investment grade CDX index. Because that's where most bears who want to try something will go first. And I actually have on my Bloomberg, I have a little screen that shows the NASDAQ, the S&P, and the Russell together with the daily movements of the IG CDX. And it isn't really tradable. The correlation is there, but I think the opportunity on a short-term basis is when there are divergences. So if you see the IG CDX widen 3-4 basis points over, let's say, a week, 5 days or so, and the equity markets are oblivious to that, that kind of presents opportunity, because at a certain point, they will notice that something is stirring in credit, and that tends to hit equities at that point. And the reverse is also true. I mean, when things start tightening, and this morning, for example, there was a little bit of a swoosh. CDXs have done very little. I mean, they've moved 0.2 of a beat. Yeah, something like that. That tells me that it's stock specific stuff, and there is no great divergence, so I wouldn't really trade on it. But should equities continue to pull back and things remain quiet in the CDX, well, at a certain point, may want to pull a trigger for a trade. That's kind of the way I look at it. Cash spreads, it's a little different. They basically, especially in periods of really strong issuance, intuitively somebody would say, well, if there's a lot of supply, prices should go down, yields should go up. And one of the characteristics of the corporate bond market is that since there is so much demand for especially high grade debt, and the companies come to market with very large issuance, let's say an Oracle, or there were a couple companies that closed deals last week. I think it was AbbVie and somebody else. I mean, the frenzy around those issues is phenomenal because you have money managers who have to put to work tens of billions, right? And they can't do it on a $500 million issue. They need these massive deals. So counterintuitively, the larger the supply, the more prices get pushed up and yields down. And you can see it both in the risk spreads. You can see it in the ultimate pricing of these issues. So yeah, cut me off if I get too nerdy on this.
No. This is all good. Again, this is an area where we haven't really had a lot of exposure before. But in your notes to me, you talk about the links between these things, but you say eventually they will be broken with very ugly consequences. So what specific scenario do you envision that would lead to that breakdown? And what would those consequences potentially be?
Right. So, and this has been one of the most fascinating periods for that, because if you look back to 2000 and then 06 or 07 or 08, the markets, the credit markets I'm talking about, broke after not during rising rates. In fact, rising interest rates coincided with some of the strongest up move in equities. But when the Fed started easing, and this time has been different. There's not a question of whether it will be different. It has been different. First of all, we have had the 210 curve inverted for the longest period since going back to the 70s, and deeper than anything else. Now, that by itself, in past lives, so to speak, would have been a serious problem for debt, because the buyers of debt are often leveraged buyers. And when the curve is inverted, it's tough to make money if you're borrowing at 5 and lending out at 4, so to speak. So I thought that ultimately the inverted yield curve would cause real problems. Well,
so did
it's now
a lot
been
of other
2
people.
years. I'm sorry.
Yeah. So did a lot of other people, and that hasn't happened.
It's been 2 years now. So, it will happen. It will happen. Of course it will happen. But the dynamic has been different. There's no two ways about it. Now,
so what's underlying that dynamic? Is it persistent fiscal policy from the US, or?
That is above my pay grade.
Okay.
I couldn't tell you. I know some guys on Twitter who are, pure bond traders and whatnot, and I basically follow their lead on what's going there because
Okay.
corporate bond market. But the uninversion of the 210 has almost always coincided, and intuitively so, with the beginning of a Fed easing cycle. And in the past, the beginning of an easing cycle after a long stretch of increases has coincided with credit crisis. In other words, I can't tell you whether it's the Fed that can see that things are coming down the pike that are not good. Certainly that was not the case in 07, 08. But the credit markets tend to break because something is coming.
And are you seeing anything that's telling us right now that credit markets will break?
No.
With the issuance of Jan Feb, it doesn't seem like that would
no,
be an issue.
and credit spreads are as low as they were in the last 20 years.
Right.
I mean, risk spreads on IG and high yield are, in the IG is 90 beeps,
Right.
high yield is 350. The threshold, if you kind of chart those spreads to equities, you can see that equities start getting rattled when investment grade spreads widen to above 150.
Right.
And high yield above 500.
Okay.
And so we're nowhere close to that. I mean, we're
This
in
is
the
such
opposite.
a weird cycle. It's such a weird cycle.
But ultimately, something will happen. It always does. I mean, these are just
something
long.
will happen.
But as a friend of mine told me once that the sun eventually will explode, but that doesn't mean it's a good bet.
Right. Exactly.
And betting on when it will explode is probably
it's a tough
not
bet
a
to
good way
make.
make money.
It's a tough bet to make.
Yeah.
Well, that's great, Phil. Thank you so much for that. I think again, it's given me a lot of new perspectives and a lot to think about. So I really appreciate that. Let's move from corporate debt to US politics. It's Friday, and so we had Super Tuesday, obviously on Tuesday, and we had the State of the Union on Thursday night, which I think 17 people watched. And Albert was probably one of them, I would assume. But so Tuesday, honestly, I don't know what you thought, Albert, but kind of boring, right? I mean, Trump swept, Biden swept. It's the least competitive presidential primary we've had in for I don't know how long. We've got two old geezers running for president. I generated a picture on one of the AI platforms of an old elephant and an old donkey kind of running a race, but it just shows how exciting I think the next 8 months are going to be, right? So I keep hearing things like Biden is going to drop out at the last minute, all of this stuff. I think we've covered this before, but I just want to go, is that even possible for Biden to drop out at the last minute?
Of course it's possible. It's just significantly unlikely, to be honest with you, for someone to step in and just take over and start up just an entire campaign from scratch. It's daunting. I mean, the money is not there. There's a lot of complexities involved with that. I mean, the only person that could step in would be Kamala Harris, and she's less liked than Joe Biden is in reality.
Right.
So I just don't, these Michelle Obama's going to sweep in comments I mean, they're a little bit silly. I don't really take them seriously. When it comes back to Super Tuesday, Super Boring Tuesday, as we refer to it.
Did you think it was exciting?
No, I didn't even watch the results. And normally I'd be watching every single results and trying to count delegates and so on and so forth. And I didn't even bother because it was an inevitable outcome. We both know it was Biden and Trump was going to take it. So it's like, what's the point? And people are starting to derive, narratives of, the turnout, Trump's got less enthusiasm because the turnout was low. It's not because the turnout was low. It's because there was no one running against him.
Right. And it's a primary.
It was
it's
really
a primary
boring.
and a fait accompli, right? So,
yeah, it was boring and nobody really cared about it. I mean, I'm sure like the ratings for the cable channels when they come out are just going to be historically low. Just nobody really cares about this primary season. So
Everyone's
I
too
mean,
busy investing in NVIDIA to pay attention.
that's right.
Right.
That's right. It's a better bet nowadays.
Yeah.
Well, except for today, I think it's down like 4% at the moment. But yeah, I mean, when it comes to U.S. political scene, I mean, it's kind of like on cruise control up until about July, when the campaigns really ramp up and start going to swing states and get their
Right.
campaign stuff out there.
So I was on BBC on Super Tuesday doing kind of political analysis, and my counterpart was a kind of Democrat Party strategist. And she insists that the court cases against Trump are going to cost him votes in November. And she specifically talked about some Stormy Daniels ongoing case or something like that. Are those court cases really a factor? Because I talk to people and I don't know of anybody who's really mentioning that stuff. I mean, I think in New York, DC, Boston, San Francisco, people talk about this stuff, but maybe I just am with the great unwashed. Does this really matter to people?
No, I mean the Stormy Daniels. I mean, listen. The Democratic strategists are out there trying to pump as much anti-Trump like woman issues they can.
Well, as terrible as these things may be, this is not new information, right?
It's not new
That's my
information.
only contention. Like whether or not I'm okay with what Trump allegedly did. This is not new information. This is 6-year-old information, right?
Yeah. I mean, the information is old and it's played out, and nobody really cares much about it. On the other hand, the other problem that the Democrats have about spinning that is these cases of where he was convicted of fraud for Mar-a-Lago valuation, where they valued the entire Mar-a-Lago for $18 million. I mean, that's just silly. It's just so silly that it discredits the entire arguments against Trump. So, I mean, I can go on and on, but realistically, voters don't care about that. Their main concerns are inflation and the job market, not some silly court cases.
Yeah, just a quick anecdote. While I was on air, they interviewed 2 voters live on air. And one of them was an African-American woman. The other one was a white man in California. And both of them were pro-Trump, completely unexpected, right? And it was, I didn't think that it went the way they wanted it to go. But it was very interesting to hear that both of these guys were pro-Trump. And I walked away just feeling really, I felt like maybe I got a different view, because I just didn't expect them to have 2 people who were pro-Trump on there. So what's different? I wasn't in the US for the 2016 election. So what's different this time? I mean, is the Trump thing different this time? Is the Biden thing different this time? I mean, of course, Biden wasn't running in 2016, but what's different?
Well, I mean, the reality is people vote with their wallets. They want to make sure that whatever happens in November is beneficial to their financial situation. And at the moment, Biden being in power is not beneficial for anybody except for whoever's playing NVIDIA and AMD calls. And it's just, and that's the reality of it. I mean, the inflation's still 25% above what it was pre-COVID. Labor market is, only tight because, immigrants have come in and flooded into some of those jobs, and they started adding up those numbers, which I just saw today, which is pretty funny.
It's statistically tight, right?
It's statistically tight. That's right. But the fact of the matter is, wages are just not keeping up with inflation, and that's going to be the biggest downfall of the Biden administration.
Right. It seems to me, and again, I could be wrong, and Phil and Tracy jump in here. But it seems to me that immigration and inflation are the 2 biggest issues when we look at people, across the political spectrum. Obviously, like Tom Friedman and those sorts of guys don't care about inflation. But, for most of the people in the US, inflation is really biting. So am I missing something? Are immigration and inflation the 2 biggest issues, at least at this point in the election cycle?
I would absolutely have to say so. There's no other 2 issues right now that would even come close to voters' top list.
Tracy, is that your gut feeling?
I Absolutely. I absolutely think that. And I think that if you listen to the State of the Union address last night, which is, I would say, a campaign speech, essentially, right? I think that those two concerns were kind of glossed over. And so that may make a difference to voters, particularly the immigration. He addressed it a little bit, but not as much as I think that he probably could have.
So you watched it. So you and
I did watch
the
it,
12
yes.
people who watched it.
I did watch it, yes.
Okay.
But he really glossed over the major things, and we know now he's on talking about, and I'm, you know, this has nothing about my feelings about Biden. I would have the same critique at whoever was president, trying to campaign. I'm just trying to look at it objectively. You know, I think he glossed over the immigration issue a lot. And, you know, he just jumped on this shrinkflation thing, which literally Twitter has been talking about for the last 5 years. So,
And so what was it about shrinkflation? Did he basically blame the manufacturers for
yeah,
shrinking
absolutely.
the
Yes,
size of goods?
exactly.
Okay.
It's the manufacturers, it's the people that own the grocery stores,
Greedy
et cetera.
capitalists.
Oh, yes,
But yeah,
exactly.
grocery store owners who make what, a 2% margin or something?
Like nothing, right? Exactly. So,
Yeah.
and really that was what it was, and it again was glossed over. I think there were a lot of issues that were talked about in depth that really, I don't think concern voters right now,
Mm,
or that, you know, people are not concerned about right now, like funding wars in other countries and
right.
things of that nature.
Right. Phil, what's your take? Immigration and inflation, is that what you're seeing as the major concerns?
I mean, I am even less of a political tourist than an expert. So my sense, I do live in DC, and I do know a lot of people who work on the Hill. My sense is that immigration is a talking point, but you know, when I ask people, okay, how has it affected you? You know, most of these people say, well, it really hasn't. I mean, you know, as long as I have my housekeeper and she doesn't want more money, I'm okay. So it's sort of like a two-way, you know, view of immigration, but that doesn't really come up much. On inflation, I think there was real concern when it was really rising fast. Now that it's back in the, you know, 2.5%, 3%, whatever it is, this is an area that it's pretty wealthy. So 2-3% inflation is really not felt much.
Right.
So that's my sense. Now, the only thing I would throw in, and this is just purely anecdotal and it's secondhand, there are people who have told me, and again, I have no idea if it's true or not, that Michelle Obama has contacted funding sources. And she still does not want to do it. It's not, you know, I think the odds that she does it are very, very low. But to the extent that she were able to be nominated on the floor kind of thing without having to campaign or anything like that, there is a small window that is still open, and people on the Hill are talking about this.
Okay. That's
so
interesting.
That is, you know, all I can tell you.
I mean,
but again,
if she were to run, let's be honest, media would be 200% on her side, right? So fundraising would be
a landslide.
Yeah, fundraising would be less of a concern because she wouldn't even have to buy ads. You know,
probably not.
All the media would be 10,000% on her side. So, I don't know. That'll be interesting to watch. Let's see if that happens. I think, like Albert, it's a remote possibility, but it's not a non-possibility, right? And
I
so,
think that's about right.
and even you said she doesn't want to do it, and I've heard from many sources that she doesn't want to do it. So, let's see. And so it's interesting that nobody's mentioned Gavin Newsom. So, I think he showed in that debate with DeSantis that he's just not ready for the national stage. I don't know. I could be wrong there, but that's kind of my takeaway. Albert, what races are you watching in the House and the Senate? Because we love to talk about the president, but what are the important races in the House and the Senate? I know Joe Manchin out of West Virginia is stepping down. He's a Democrat. Will that remain a Democrat seat?
No, Jim Justice will win that pretty handily.
And he's the governor now?
Yeah, he's the governor now, but he's term limited. And I heard, this a year, maybe 2 years ago, I heard that Manchin was not going to run for Senate, and he really wants to run for governor. So I wouldn't doubt a governor race for him later on.
Okay.
Yeah. So the only other Senate race that I'm really interested in is Tester in Montana. I want to see if he can actually hold on to that seat or not. Because I'm thinking more or less where the GOP takes the Senate, and probably the GOP loses the House.
Okay.
Yeah.
And why would they lose the House? Where would they lose seats?
They're going to probably lose some seats in Michigan.
Okay.
Maybe outside of Wisconsin, Milwaukee, Wisconsin area, they'll probably lose a couple seats here and there. Pennsylvania, pretty much the swing states that Trump and Biden were fighting about in 2016. If I had to guess today who would win the presidential race, I think it would probably be Trump if all said and done today. But GOP loses the House, so still status quo. Nothing really gets done. Pretty much the same as what's been happening with Biden with the GOP Senate.
Yep. Which, from a U.S. citizen perspective, I'm okay with that. Because there's less trouble. There's less trouble they can get us all into, right?
A balanced government's fine with me. I don't. They want status quo is fine with me.
Exactly. Okay. And then, are there any kind of major state level issues that you're watching for November?
Not really. I do think that the abortion issue is going to probably pop back up towards the end of the summertime, just because it's such a great vote driver for Democrats. But that's right. The only other issue. From when it comes to economic policies, I still think that agriculture and maybe like auto industry might get some subsidies thrown at them.
Okay. So, Biden mentioned Roe versus Wade a few times. I just want to make sure I understand this. And if I'm wrong, we've got, all three of you correct me. But my understanding of the Supreme Court ruling is it did not make abortion illegal. It simply made it a states' rights issue. Is that it? I know that's really boring and less spectacular than people like to talk about on, cable news or whatever. But it really just made it a states' rights issue, right?
Yeah, that's all it made it. And obviously one side wanted it to be codified in the Constitution, and the Supreme Court's like, just let the states decide on their own, which is, I think, is probably the right thing to do. But that's just my personal opinion. I personally don't like the abortion issue at all. I don't like talking about it. It's really not a woman.
Right. But it's going to be there for the next 8 months.
So for sure. Oh, I guarantee you that.
Right.
It's for sure going to be there for that.
Right. Okay, great. Albert, this is great. So speaking of political moves, I'll hold as to whether or not this is a stupid political move or not. But dumping of the U.S. gasoline reserve, Tracy, we saw a story out this week about the U.S. selling down the Northeast gasoline reserve. We've got a Reuters story on screen. This is 1 million barrels of gasoline. It's about 31.5 million gallons of gas, or petrol for those who don't speak American. So Tracy, your view on this is kind of subtle. So you called this, quote, one of the stupidest ideas ever. And so the bill says the gas has to be sold in fiscal year 24. So that makes me think that and I could be wrong here, so tell me if I'm wrong. That makes me think it's kind of a campaign move to lower gasoline prices before the election. That's a cynical view, but it also benefits all of the sitting politicians, whether Republican or Democrat, because people get upset about gas prices and they go to the polls and vote based on household spending. So I know I'm not seeing all the issues here. Can you kind of tell us what's going on here and whether my read is reasonable?
No, absolutely. And I think on the outset, you could look at it this as this is a completely political move. The problem is, it's not only do they want to drain it, they want to shut it down forever. They just want to shut it down. Like, we're shutting this whole thing down. That leads me to believe there's something a little more, I don't want to say sinister, but I would say idiotic involved in this decision, because we have to look at
Keep in
first.
mind, Phil knows people on the Hill, so you know.
All right.
we want to upset his friends.
I
You know-
honestly have no idea what you guys are talking about. So.
It's, it's 1 million barrels. It's not a ton. And to be honest, I mean, we had a 4 million barrel draw just last week. So 1 million barrels is not really enough to move the needle, to be honest, to bring down oil prices. It's just not. Let's be realistic. Even though it sounds like it would, it's not. The problem is that, the Northeast gasoline reserve is there for a specific reason. One, there's lack of pipeline capacity because they don't want pipelines up there. And there's also now lack of refinery capacity now that Pennsylvania's largest refineries had to shut down.
It was like 120 years old or something, right?
Yeah, a few years ago. And so the problem is that now the Northeast really imports more gasoline than they get domestically, and we get that from Europe. So the thing is that if you want to look at this in the way that, the Biden administration just said, we're going to halt natural gas export permits right now. Europe got very angry about that and said, wait a minute, you just said that you would help us if we stopped importing Russian gas after all of this. And so what they could do is say, well, we're not going to send you any more gasoline or diesel to the East Coast. So I'm just thinking 2 steps ahead. I'm not saying that that could happen, but certainly if I were a politician, I would use that to my advantage.
Yep.
Right. And so
Especially as Europe becomes less, I think, aligned to US interests and more aligned to other interests.
Right.
I hadn't thought about that. I think that's a really, really brilliant perspective.
So, I just think and then that's not to mention the fact that, this is a problem for the Northeast, because if there's any kind of disruption, then they just don't have that backup, right? It's kind of a national security thing, particularly for that region, just because of the limited access they have. And so, so again, I just think it's the dumbest decision that I've ever heard in my entire life. It's not going to make a dent in gasoline prices. And you're talking about literally shutting the whole thing down forever.
Because how much, 1 million barrels of supply for the Northeast, how long would that be? A week? Something like that?
Yeah, about a week. But it's if you had a total emergency, or if you had slower flows there, or for any, who knows what reason could come up.
Right.
But, it's just that safety. It's just that backup. There's definitely not one reason to shut it down unless you were saying, okay, we're going to build a bunch of pipelines and we're going to build a bunch of refining capacity. That would be great for the Northeast.
Which is not going to happen.
But that's not going to happen. So I just think this is a very short-sighted decision. I do not understand it at all, because literally it's not going to make a dent. It may come off politically as, oh, look, we're going to release this gasoline. It's going to make, but the reality of the situation is that it's not going to. And really, this comes down to what I've said from the onset of Granholm being part of being the energy head. Is this whole administration has made a lot of missteps. Yes, we are producing more oil now, but that's in spite of.
So this would have been a policy that Granholm would have had to politic for, right?
Absolutely.
Okay. I just don't understand the reason.
I don't either, Tony. I don't.
Yeah, I just don't get it. Maybe there's brilliance there that I'm not seeing. I have no idea. But it seems, you say it won't have a material impact on gasoline prices, fine. But it does have a material impact on risk, on say, short-term risk, especially in hurricane season, right?
Absolutely.
So, and what does it cost to hold that stuff every year? Is it billions of dollars to
No, it's
hold that
minimal.
stuff in storage?
It's
No.
minimal. It's minimal. They don't have, there's not a lot of upkeep involved in it. It's not stored like the SPR is, where, you know, we've had to put billions of dollars in upgrades for that. And so it's not, it's a very small storage. $1 million is, I know it sounds like a lot, but it's really
Right.
not. It's a very small kind of storage. Absolutely.
That's a weird policy decision. I don't get it. Maybe, let's see what, and so that's passed? Has that passed? Is that going?
No,
It hasn't passed.
that has not passed yet. This is up for a vote. This is not passed yet.
Okay. Okay. Well, we'll see. If it does get passed, let's talk about it, because I would be interested to understand if that's happening or not. Okay. Guys, thank you so much. I really appreciate your time. This has been a fascinating discussion. So have a great weekend, I hope, and have a great weekend. Thank you, guys. Thank you so much.
Thanks, guys.
Thank you.
Cheers.